Austan, thanks for joining us. I feel like the debate that folks in the market are having now is, so the Fed was late to get on top of inflation. Are they late to getting on top of the peak of inflation and getting too hawkish at a time where it's really starting to come down?
Oh, yeah, well, they might be. You know, as you say, because they felt like they were behind the curve, they've got to talk tough now, and they have been, and all the governors have been, and Chair Powell has been. But we've gotten 2 months of CPI numbers that were, at least the new information, quite positive. And if next week we got more good news on CPI inflation, you have to think there's going to start to be a little pushback where people say, whoa, wait a minute. You know, should we be raising 75 basis points at every meeting if the impulse of inflation is not what it was 6 months ago?
So is your view that they should not, that they should start to calm down a little bit?
Well, I think now's a moment where for the next 3 months, the new month-to-month core inflation is going to be hugely important, and they should be data dependent and keep their eye on that. I think the pre-committing that we should just raise rates as fast as really we've raised them in decades, regardless of what we see from the data, that seems a little extreme to me.
Well, we know it's going to come down at the next. The average price of gasoline in this country is $3.73. It was, I don't know, almost five a month ago. So headline inflation is going to come down, Austan. The question is what kind of damage is going to be done in the meantime to the economy. What do you think?
Yes, I agree with that. But as you know, the Fed doesn't really look at headline inflation. So even though for everyday consumers, they care probably the most about gasoline and food, that's not in the Fed's calculation. They're looking at core inflation, and they're looking at what are those new month-to-month inflation rates. And we don't know. Last month, that improved a lot. Some of the months before that, that core measure was actually getting worse. And that's when the market began to freak out because they thought the Fed was going to go to town. The Fed needs to be data dependent now. It's more important than ever.
What is your expectation for what happens to the economy, given higher interest rates, which do hit us with a lag, right? QT, the shrinking of the balance sheet, which they're finally getting going here in force, these price shocks, what's happening around the world. How is the U.S. going to hold up?
Partly that depends on, are we truly going to put the COVID era behind us? If so, we're going to get a nice tailwind from that, which is a thing which has just been dragging us down over the last 2 years, but we get a positive. But don't kid yourself. If the Fed keeps raising rates, that's been the most common cause of recessions in the history of the United States since we've been keeping the data. And the sectors that will be hardest hit, you've already seen them get hit. Housing's going to be hit, automobiles, consumer durables, all the things that are interest rate sensitive. That's where the Fed is going to tighten the screws. If they need to cool the economy, that's who's going to be hurting the most. And that's not necessarily the same people that led to the problem, if you were, of overheating. The overheating is going to be coming from the service sector as everybody goes back on vacation because they haven't been able to go out of their houses for the last 2 years and go get elective surgeries and stuff like that. So the balance of the who's hurting and who's overheated, those discussions are going to get a little more heated themselves.